Hello everyone, I hope so you will be fine. So today we are going to talk about dividends. Actually, in CMA exam, uh, they also ask the question about dividends, especially like which factors affect the dividend policies. Okay, and they also ask the question about importance of stable dividend policy. So you should know like what is the dividend and what factors are there which may affect the dividend policy. So here we go. So guys, first of all, dividend means a dividend represents a distribution of earning. Like for example, as a company, uh, whatever net income we have in our statement of profit and loss account, from that net income, we always pay first preference dividend to the preference shareholder, and then we pay dividend to the common shareholders. Okay, so dividend actually represents that what portion dividend, when we talk about dividend policy, it determines what portion of the corporation's net income is distributed to the shareholder, like how much part of the profit we should pay as dividend and how much part of the profit we should retain for the reinvestment purpose. For example, if our net income, I'm assuming for example $100, let's assume out of $100, let's assume we are going to pay dividend of $40. Let's assume it means $60 we are going to retain. So this $60 will be the part of retained earning. And what is the use of retained earning? Obviously, the company can use this source or this amount to invest into the future project, right or wrong? So if you will pay more amount of dividend, okay, it means you are retaining less. But if you would pay less amount of dividend, it means we are retaining more. So now simply dividend policy is the decision like what portion we have to distribute as a dividend among the shareholder. So here we go. We have a first point, high dividend rate. What is high dividend rate? That if you are paying huge amount of dividend, okay, it means you have a slower rate of growth. Why? Because when you pay higher amount of dividend, it means your retained earning will be less. If your retained earning is less, so you would reinvest this amount. Obviously, you are reinvesting less amount, and your business growth will be slower automatically. On the other hand, a high growth rate means if you are retaining more, if your retained earning is more, obviously you will reinvest or you will invest more. So it means if your retained earning is more, it means your dividend will be less. So this is second point. High growth rate usually means a lower dividend rate. So guys, being a manager, because this is very difficult situation, that should we pay higher amount of dividend? And if you will pay higher amount of dividend, your growth rate will be less. Or should we pay less amount of dividend to increase the growth rate? This is very complicated decision. And usually as a manager, we will always try to create the balance between these two things, between the dividend rate and the growth rate, right? So you have to think about the both aspects you have to think. Then guys, there is other point also. Sometimes there are certain shareholders, so they invest into the company's stock or company's shares just with the expectation of receiving a certain amount of dividend every year, because they want, like for example, if you are a retiree person, so obviously to create your routine income, so what you can do, you would invest only maybe in the stock of those company which are paying stable dividend, right? And they want dividend. But if you are not a retiree, if you are far away from the retirement, maybe in that scenario you may think this way, that you need less amount of dividend, because if company would pay less dividend, so more amount they will reinvest. And if they will reinvest, so their business will grow. Once business will grow, so share price will grow and you will get the capital gain. So the point is, sometime it depends upon the preference of the investor. Some investors, they want a huge amount of dividend. Some investors, they want capital gain. Capital gain means say increase in the stock prices. And stock prices will increase only, guys, mainly if the business will grow, right? So this is what is the point you have to remember. Now here the main thing which we are discussing here factors influencing a company's dividend policy. So what is the question actually? This question mean to say that should we pay higher amount of dividend or lower amount of dividend? It depends upon the number of factors. It depends upon number of factors. So those factors we are going to discuss, which will help us to decide our dividend policy, that should we pay higher amount of dividend or lower amount of dividend. So first factor could be a legal restriction. Legal restriction I can explain in two different terms. So guys, please remember, legally, when we issue the stock, let me tell you, so we always debit the cash. For example, I issued 100 shares. Okay, 100 shares are there, and par value of the share is let's assume $1, but I have issued the stocks at $3. So when we record the double entry, so we debit the cash always with the issue price. So 100 shares are there with the issue price of 3, so value will be $300, and credit will be a common stock. Okay, with the par value, always 100 shares, par value is the $1. So this credit will be with the $100. And credit will be additional paid in capital. Additional paid in capital, how the difference of these two, which will be 200. Okay, because additional paid in capital is always the difference of par value and the issue price. So now guys, the point is, what is legal restriction? Legal restriction here I'm explaining. So legal restriction is that company cannot use this reserve to pay as amount of dividend. Okay, so what company should have to do? The company need to get their profits. Profits means say retained, like a retained earnings, and they should use those retained earnings to pay the dividend. They should not use this paid in capital amount. This is what is the first point. So sometime legal restriction, I can give you another example. For example, sometime you may have taken some loan from the bank, and in the loan agreement, the bank can add certain covenants, certain conditions. For example, maybe the condition of the loan is that you cannot pay the dividend for next 2 years, or maybe you can pay dividend only 10% of the profit. So these kind of legal restrictions we have to consider, and these legal restrictions will help us to decide the dividend policy. Understood? Second point is what? Stability of earnings. So guys, actually, this is just a general discussion. You can take both way. Stability of earnings means to say, like, for example, sometime, let's assume, if company is earning a higher amount of profit, I'm just assuming. So what company, the good companies, what they will do, they will pay here in this scenario, if the profit is higher, so they may pay the smaller amount of dividend. Okay, why they are paying smaller amount of dividend? The reason, maybe in future, if your profit will fluctuate, obviously, there are up and down, right, in the business or in the economy. So if your profit will fluctuate, or if your profit is lower in future, for example, then the smaller amount which you are paying at the good time, so you can continuously you can pay the same amount. So this is kind of stable dividend policy. Right, it's not necessary that if your profit is higher, so you should pay higher amount of dividend, or if your profit is lower, you should pay a lower amount of dividend. So you can follow anything. So this is what is written here. They're saying a company whose earnings fluctuate greatly from year to year will tend to pay out a smaller dividend during the good years. Like in the good years, where when you are having a higher amount of profit, you may pay the small amount of dividend, so that the same dividend can be paid even if profit is much lower in the future. Understood? For example, here example is here. For example, if your earning per share is $10, okay, but you are paying $1 as a dividend, it means our payout ratio is 10%, right? How? Because payout ratio, we learned in the ratio analysis, we need dividend per share divided by earning per share and times 100. So you will get dividend payout ratio. So dividend per share is 1, EPS is $10 into 100, so you are paying 10%. So okay, or this is what I'm just trying to explain. So if your earning is $10, you will pay $1 of dividend. Or even if your earning is $1, still you can pay this $1 as a dividend here, even the payout ratio is 100%. So this is what is the point, stability of earning. This factor we also need to consider. Then rate of growth, this I have already told you. Like if you are linking two things, like especially you are linking dividend with the growth, So as I told you, for example, if you have a net income, out of this profit, you would pay some amount of dividend and remaining amount will be the part of retained earning. Okay. So for example, if you want to grow your business, so you have to retain more. If you have to retain more, then you should pay less dividend. This is what is the rate of growth point. That in case if you want to grow your business, it means you have to invest this money. So then you should retain more and you should pay less amount of dividend. But if you don't have any opportunity to invest, then maybe you can uh, pay more amount of dividend. So this is what these kind of factors you have to think. Do you want to grow your business or not, right? This is what is rate of growth. Then when we decide how much dividend we should pay, we also consider the cash position. For example, if you have excessive cash with the business, so you can pay more amount of dividend. But if you don't have excessive cash, then you can pay small amount of dividend. So cash position will also help us to decide the dividend policy. Okay, so then restriction in debt covenant, this I have already explained with the legal restriction. Sometimes, when we take a loan, so lender, like a bank, they can impose certain restriction on the dividend payment. So they may ask us maybe to pay only 10% of the profit as a dividend, or maybe they can also force us not to pay a dividend in for 1 year or next 2 years. Okay, so these points you also need to consider. Do we have any kind of restrictions in the debt agreement you have to consider while we are setting up our dividend policy. Then you also need to consider, guys, tax position of shareholders. I can just explain this point with the help of example. For example, I'm the shareholder, let's assume. So, for example, I'm living in a country where there is a high tax rate is there. High tax is there on what? On the dividend income. And there is a, let's assume less tax is there on capital gain. Capital gain, I told you, increase in stock prices. And when we sell, maybe, for example, if you bought a stock for $1, maybe if I sold this stock, let's assume $3. So $2 is my capital gain. So this on the gain, maybe I have to pay tax. Okay, there is a capital gain taxes there. So guys, what is my point here? So while we are setting up as a company, while we are setting up the dividend policy, so we should always consider the tax position of the shareholder. For example, if shareholders are having high brackets of tax, so then maybe we should pay less amount of dividend. If they are less taxpayer, or if they are lower rate taxpayer, then maybe we can pay huge amount of dividend. Or another example, for example, where I'm living, let's assume there is a more tax on the dividend. So then as a company, what I should do, I should pay less amount of dividend, because otherwise they have to pay more tax, right? And I should try to give them capital gain. But if I'm living in a country where there is a huge amount of tax, or a huge rate of tax on the capital gain, in that scenario I should pay more amount of dividend, because i I can save the tax for my shareholder. So this is what is the tax position we also need to consider. So where we are, the market in which we are doing business, we have to think about tax position of the shareholders. So this is what is this point. So then, guys, there is also next point. This is called residual theory of dividend. So what it means, guys, actually it is one of the school of thought. Okay. So what it means, for example, as per this theory, what we should do. For example, they are saying that first of all, company should give priority. Okay, priority to what? To retain earnings. So they should actually retain the maximum amount of the profit, and then they should reinvest, or they should invest this money into different investment opportunities, right? So for example, I have $100 of retained earnings, let's assume, or $100 of profits, let's assume. And first I will try to invest this amount. If anything is left, for example, out of that 80 out of 100, 80 is invested in the investment opportunities. So remaining 20 residual amount I can pay as a dividend, right? So this is what is the theory. Residual theory of dividend mean to say, first we should try to check is there any investment opportunity. If yes, we should try to invest our money into that. And if anything is left, that can be paid as a dividend. This is called residual theory of dividend. This is what is the point is explained here. They are saying the amount means the residual remaining amount of earnings paid as dividend depends on the available investment opportunities and the debt equity ratio. This is also important, guys. Obviously, I'm just telling you, for example, please try to listen. This point I have already explained investment opportunities. Now let me tell you debt equity ratio because it has effect on cost of capital. So let me give you example. For example, we know what is debt ratio equity, right? So we know if we have a net income and if you are paying less amount of dividend, less. So then what will happen? Your retained earning will increase, right? If your retained earning will increase, retained earning is always part of equity. So it means your equity will increase, right or wrong? So so it means the payment of dividend can affect that equity ratio because we pay always dividend from the retained earnings, right? If you will not pay dividend, your retained earning will be higher, equity will be higher, right? And your risk will be lower. But if you are paying huge amount of dividend, then retained earning will be less, equity will be less, right? And then obviously if equity is less, it means that equity ratio it will become worse. So and which will have the effect on cost of capital. And because for companies a minimum cost of capital is really important. So what is cost of capital, that I'll explain in the future. But just you have to remember the payments of dividend will also affect that equity ratio, which can have effect on the cost of capital. Understood? I hope so it is clear. Now, guys, we are talking about important dates relative to dividend. This is also really important concept. So, guys, first of all, we have a first date which is called date of declaration. Then we have a date of record. Then we have a date of distribution or date of payment. And then we have a ex-dividend date. So we have to remember for these points. So first of all, what is date of declaration? Actually, date of declaration is the date the directors meet and formally vote to declare a dividend. For example, this is the, let's assume this is the uh, 31st August or 31st August, for example. At this date, board of directors, they had a meeting and they decided that how much amount of dividend they will pay. So this dividend is declared at this date. This is called date of declaration. And I'm assuming, for example, dividend will be paid, just assuming dividend will be paid in January of the next year. For example, by 31st, or let's say by 30th January, or by, let's assume, I'm assuming January 15th is the date of payment when dividend will be paid. Okay, so date of declaration means say when the dividend is declared. Okay, and the date of payment means say when the actually dividend will be paid. Now, please remember, guys. Now I want to tell you what is the date of record. Date of record. First, you have to understand the concept. So, date of record mean to say, as a company, you should know to whom you have to pay dividend, right? To whom you have to pay the dividend. You should know, right? So it means there is a date of record in at this date. Okay, the company will check their system and they will see who are their shareholders and they will take their names and then that dividend will be paid to dividend will be paid only to those people who were the shareholder on the date of record. So this is what is the date of record. Now let me give you more information about this. So date of record is the date as of which the corporation determines the shareholder who will receive the declared dividend. And now the point is that date of declaration, date of record will be in between these two dates. Okay, between date of payment and date of declaration. So date of record is always in between, right? So date of record is always in between. Okay, the date of declaration and the date of payment. Now here we go. Only those shareholder who own the stock on the date of record will receive the dividend. Yes, as I told you, only those people who were the shareholder at the date of record. So those people will receive the dividend. Now the point is that so it typically falls from 2 to 6 weeks after the declaration date. Okay. And it can fall between 2 to 4 weeks after the date of sorry, this is something distribution. So date of record, they are saying that date of record usually falls from 2 to 6 weeks after date of declaration. So actually maybe 2 to 3 or 2, 3, 4 weeks before the date of payments. So they will set the date of records. It's not necessary it will fall only after 3 weeks. It's choice of the company. So but the date of record will fall after date of declaration. Okay, 2 to 6 weeks. It typically falls from 2 to 6 weeks after the date of declaration. Okay, I'm just assuming, for example, 15th December is the date of record at this date, because date of declaration was 31st August and date of payment is January 15 of next year, and 15th December is the date of record. At this date, company will check its system and will see who are the shareholders, okay, at this date, and only dividend will be paid to them. This is called date of record. Okay, now we have here ex-dividend date. This is another point, please remember guys. Now I'm assuming my date of record is what? 15th December. This is my date of record. Now guys, please remember, usually if you will just move back any person, I'm going to explain now ex-dividend date. Okay, now what is ex-dividend date? So this is another thing, please, you have to remember. Ex-dividend date is a date established by the stock exchange. Who will decide this date? Stock exchange, such as 2 business days before the date of record. Okay, so let's move here because you have to understand the concept completely here. So we have here 15 December is the date of record. Just 2 business days before, for example, 13th December is the ex-dividend date. Ex-dividend date. Now you have to remember what is this ex-dividend date. Now guys, application of ex-dividend date I'm going to tell you. So ex-dividend date will fall 2 business days, 2 working days before the date of record. Now please, what is the application of this? Now here you have to understand, any person who will buy the stocks before this date, before 13 December, because for example, if today I'm buying the stock, maybe 1 or 2 days I need. Okay, our company will take our stock exchange will take 1 or 2 days to update his transaction, that who is the shareholder of this stock now, right? So that is why if date of record is 15 December, I'm saying that ex-dividend date will be decided 2 working days before, because usually 1, 2 days working days we need to process a transaction. Now any person who will buy or who would sell the stock before this date. For example, if I'm buying the stock before the ex-dividend date, so then now because if I am buying the stock before the ex-dividend date, so then at the date of record, automatically I will be the shareholder, I will receive the dividend. Right or wrong? Because 1, 2 days are required to update the system, right? So any person who will buy the stock before the ex-dividend date, so then he will receive the dividend. And any person, for example, any person who buys the stock between these dates, between date of ex-dividend date and date of record, between this. So if, for example, if I'm buying the stock in these 2 days, so then maybe the seller will receive the dividend, because at the date of record, still seller will be the owner of shareholders in the records. This is what are the 2 points. Don't confuse it. So remember, ex-dividend date falls 2 business days before the date of record. Okay, and now here is the application. What is the application? Application: any investor who buys a share of stock before ex-dividend date will receive the dividend that has been previously declared. As I told you, if you will buy the stock before the ex-dividend date, so then you will receive the dividend. But any investor who buys the stock on or after ex-dividend date, in my example, 13 December was ex-dividend date. So any person who are buying on 13 December or after 13 December, okay, which was ex-dividend date, but before the date of record, okay, or before the payment date, like simply from any person who will buy the stock on 13 December, okay, on or after 13 December, but before the date of payment or even the date of record, then he will not receive the declared dividend. Then who will receive the dividend. The person who is selling the stock, he will receive the dividend. I hope that is clear, right? So that's why I told you, usually guys, this note you should remember. Normally, a stock price will drop on the ex-dividend date by the amount of dividend, because share price will be, because if you are buying the stock before ex-dividend date, so I know if I will buy the stock before ex-dividend date, so I will receive the dividend also. So that is why stock price usually will increase with the amount of dividend, because buyer, he knows that he will receive the dividend as well. So he is ready to pay for the amount of dividend also. But as ex-dividend date will pass, so automatically share price will decrease, right? Because we know the seller will receive the dividend, not the buyer. So as a buyer, I will not pay any excess amount, or I will not pay any extra thing to the seller. Understood? This word is the note. A stock price will drop on ex-dividend date by the amount of dividend, because the new investor will not receive it. I hope so it is clear. Now, guys, we are going to discuss stock dividend and stock split, although we have studied this thing in the part one also. So let me tell you, even it is a stock dividend or even it's a stock splits. Okay. So here the company will issue additional shares to the existing shareholders. For example, if company is paying stock dividend means that dividend is paid in shape of stock, right? So obviously, company will issue new shares to the existing shareholders, or even if it is a stock split, again, company will issue additional shares to the existing shareholder. In both cases, in stock dividend and stock split, so issuance of additional shares are there to the existing shareholders. Now, let me tell you what is stock dividend. A stock dividend is an issuance of stock and entails the transfer of a sum from the retained earnings account to the paid in capital account. Actually, simply, so when we issue the stock dividend, so obviously first we will dab, this is actually the double entry is written. We will dabber the retained earning, and we will credit the common stock with the par value, and we will credit the additional paid in capital. So let me give you example here. For example, the day when we made a stock dividend, at that day market value of stock was $10. Okay, and we are going to issue 10 shares as a stock dividend. And what was the par value? Let's assume $1. I'm just assuming. So here debit will be retained earning will always be with the market value. So for example, there are 10 shares, market value is also 10, so $100. And common stock will be the with the par value. Okay. So for example, 10 shares are there into one, so $10, and remaining $90 will be additional paid in capital. So this is what they are saying, that usually when we issue the stock of the dividend, so we can pass this entry, or at the time of retained and at the time of declaration we can pass this entry, and that market value we have to use, right? And these are temporary accounts we open. Common stock, this is also temporary account. Additional paid in capital is also temporary account. And the day when we will issue these stocks, actually we will issue, so we will dabber these temporary account and we will credit to the permanent account. So what entry you will pass? You will dabber the common stock with the par value, because this was temporary account, right? Okay, and then we will dabber the additional paid in capital, okay, with $90, because it was also temporary account, and then we will credit to the permanent account. So which permanent account? To again common stock, this is permanent account. Okay, $10 and two additional paid in capital, this is also permanent account, $10. So it means these two accounts, temporary accounts we create, which will be eliminated at the day when stock will be distributed as dividend. And direct entry if you want, so you can dabber the retained earning and credit the common stock permanent account and credit the additional paid in capital permanent account. This can be the direct entry, and these two things will be eliminated. These credit, this debit will be eliminated. Temporary account will be eliminated. So this is what the point actually they are trying to explain. They are saying at the time of stock dividend, so we will issue the stock, okay, and entails the transfer of some from retained earnings. We'll take some money from the retained earnings account to the paid in capital account. And please remember, stock dividend takes place when a company distributes new shares to existing shareholders. Like you're giving new stock to existing shareholders, on a pro rata basis. Pro rata basis could be what? Maybe 1 for 1. Like one new share you will give for existing one share. It could be 1 for 5. You will give one new shares for every 5 existing shares. So it is always distributed on pro rata basis among the existing shareholder. So this means that each shareholders maintains the same proportion of ownership. Please remember here, guys, voting rights will not change. For example, if you are a shareholder, previously you are having 10% of voting rights, and now even you are receiving stock dividend, still your voting rights will remain the same. Okay, the reason, because if your shares are increasing, so total number of shares of the company is also increasing with the same proportionate, right? So your voting rights will be unchanged. Understood? For example, I can just give example. For example, Mr. A is there. Mr. A, he is having 10 shares only, and company's total shares are 100. Assume total shares are how much? 100. Companies total outstanding shares are 100. Mr. A is having 10 shares out of that. If you will calculate the proportionate, so it means he's having 10 out of 100 shares into 100%. So he is having 10%, right? Now, if the company will make 1 for 1, let's do 1 for 1 stock dividend. So it means if you're having old one shares, you will get one new shares. It means now Mr. A will get 10 new shares, right? Because for every one he will get one. So for every 10 he will get then 10, right? And similar way, company will also issue 100 new shares to all shareholders, including Mr. A, right? So it means now if you will add 100 old plus 100 new, which will be issued as a dividend, total will become 200. And here total will become 20, because 10 previous shares, 10 new shares will become 20. Again, you will calculate the percentage. So 20 holding of Mr. A divided by total shareholder of the company into 100. So again, percentage will be how much? 10%. So that's why I told you voting rights remains the same. This is what is the point. So whenever stock dividend takes place, so obviously each shareholders maintains the same proportion of ownership. Next point, stock dividends do not change the value of the company's assets. Okay, so stock dividend are simply accounting changes that results in the shareholders shares being more in numbers but worth the same amount. So what it means, just number of shares will increase, but worth is the same. Worth is the same. Understood, guys? Number of shares will increase only, right? So worth will not change. Proportionate will also not change. Then here, also remember, now I'm telling you stock split. Stock split. Okay, now tell me first, what is the benefit of the stock dividend to the company? Obviously, if company doesn't have any cash, so he can still give the shares as a dividend to the shareholders, and investors may believe they are receiving something of value, right? Right, something of value. So this is what is the benefit to the company. So it means if company doesn't have cash, so they can use the stock dividend to pay the dividend. Then we have a stock split. So please remember, stock split is also same like a stock dividend, but what's the difference? Stock split is at larger scale, but stock dividend is at a smaller scale. Okay, please remember, stock split does not involve any accounting entries. We don't do any accounting entries. So instead, the existing shares are divided into more shares, so the market price per share will be reduced. So I'll just give you example. For example, guys, there is a company whose each stock value, for example, each stock, one stock value is equal to $100. So now I'm trying to explain what is stock split. For example, if company will do 2 for 1 stock split, 2 for 1 stock split. So what will happen? So it means if you're having one share, so worth was $100. Now this one share will be converted into two shares, because 2 for 1 means every existing one share will be converted to two shares. Now your existing one share will be converted into two shares. So it means now you will have two shares. Right, one share you already have. So 2 for 1 stock split is there. So it means one share is going to convert into two shares now. So previously value was $100. Now the value of this share will be $50, right? So value will be reduced automatically, right? Because previously stock prices was higher. So this is the motive of the stock split. So company issues additional shares actually to reduce the value, right? So now these two shares will worth 50 each. So again, total value will be unchanged. So it means in the stock split, what will happen? So number of shares will increase. So market value per shares will decrease, but total value will remain unchanged. Remember these 3 points, okay? And even your voting rights will remain unchanged. 4 points you should remember. So this is what is the point here. They're saying stock split does not involve any counting entries. Instead, existing shares are divided into more shares. So the market price per share will be reduced. So the greater the number of shares issued, the lower the resulting share price. Obviously, if you will new shares, because you're converting one share to two shares, so it means you have to issue new shares. So automatically supply of shares will reduce the value. Now, so guys, please remember now I just want to tell you other way around. So this is what first let's see the example. They're saying if a company has 1 million shares outstanding, company has issued 1 million shares which are outstanding, each of which sells for $90. So it means for each share value was 90. Now 2-for-1 stock split will result. 2-for-1 what? This 1 million share will be multiplied with 2-for-1. So automatically it will become 2 million shares now. Okay, so 1 million is existing shares, 2-for-1 is the fraction, right? 2-for-1. So 2/1. So it means now new outstanding shares will be 2 million, and the shares price, because shares became double, so share price will become half. Okay, $45. Now you should remember what's the benefit of stock split. So as I told you, just our purpose is to reduce the market value of the stock. If you will, for example, $100 stock or $90 stock is converted to $45 stock, right? So now what is the benefit? Obviously, small investors who doesn't have huge amounts, so they can also buy the lot of or buy the stocks of this company, right? Because price is $45. So, but what will be the benefit to the existing shareholder? Because once the price will be half, okay, or less, so automatically demand of the stock will increase automatically. If demand will increase, maybe so far value was 45, so this value can convert into 46 or 47 later. So it means existing shareholders can also get the benefit, right, of $1 or $2, right? So it means both benefits are there to the new shareholders also. So new investors can invest at $45. So what will be the benefit to the existing shareholders? Because so far value is 45. Once demand of the stocks will increase, automatically price can also increase, and this increase in price can give the benefit to the existing shareholders also. Understood? Now we have here advantages of issuing stock splits and dividend. So the advantages of both is written here. Because more shares will be outstanding, because number of shares will increase, the price per share will be lower. Yes, this I told you. The lower price, the lower price per share will induce more small investors. I told you more people can invest even with the small money to purchase the company stock. Thus, because demand for stock is greater, the price may increase, and this increase in price can give the benefit to the existing shareholders. Understood? We also have here 2 points. A dividend or split can be publicity gesture, because here you are giving free stocks, right, to the existing shareholders. So this could be a publicity stunt also, because shareholders may believe they are receiving something of value. Okay, they will have a better opinion of the company. Yes, if anyone is giving you gift, maybe, so you will always have a better opinion about that person, right? And if that person is selling some goods, so then you would buy their product also. So this is what is the benefit of the company now, because when company do the stock split, so obviously company will have more shareholders, because new shareholders will also come, and once the shareholders are increasing, obviously those shareholders would buy the company's product also. So automatically company's customer base will also increase, and company's revenue will also increase. Understood? So this is what is the stock split and stock dividend and their benefit. Now I'm telling you here what is the reverse stock split. Reverse stock split is opposite. For example, previously I told you 2-for-1 under stock split. 2-for-1 means what? So you are give one existing share is converted into two new shares now in the stock split. But in the reverse stock split, it will be opposite way. Maybe it could be a 1-for-10. Like existing 10 shares will be converted into one new shares now. So this is what is reverse stock split. So reverse stock split, reduces the shares outstanding. Yes, existing 10 shares, for example, will be converted into one new shares. So it means it will also reduces the shares outstanding, thereby increasing the market price per share. Yes, in stock split, market prices was decreasing, but in reverse stock split, when your number of shares will reduce, your market price will increase. It is opposite way only. Understood? So this is what is called reverse stock split. So then guys, we have here shares repurchase. This is another small concept. So what is share repurchase? So a share repurchase takes place. Obviously, for example, if you are a company, so first you can issue the stock, maybe due to any reason in future. So you can buy back your own stock from the public, buyback. You can repurchase. So this repurchased stock, whatever stocks you will repurchase, so that is called treasury shares also, treasury stock also. So this is what they're saying. A share repurchase takes place when a corporation buys its own stock back on the open market once in the once in the firm possession. Like simply you are buying back your own stock, and these shares are called treasury shares. So what are the motives of repurchase? There could be several reasons why company is buying back. So guys, first thing, mostly we need permission from the stock exchange when you are going to buy back your own stock, right? For example, there could be several conditions. For example, if your market price of the stock is below the par value, then you can request the stock exchange because your stock is not performing well. So you can request the stock exchange and you can buy back your certain shares. This could be the reason. Other thing, maybe other thing is what once you will buy back your shares, so outstanding shares will be less, right? For example, total issued shares were 100. Out of 100, 20 shares you have repurchased, remaining 80 is the outstanding. These are issued, this is repurchased, this is what outstanding. And obviously if you will repurchase 30, outstanding will be 70. So this is what they're saying. So tax advantage to shareholders, a favorable capital gains. This is what it means. If you will repurchase more stocks, obviously stock price will increase, and if stock price will increase, so capital gains will be more for the existing shareholders, right? For the shareholders there will be capital gains, and if there are less tax on the capital gains, so it will benefit the shareholders. Sometime to increase earning per share, company do stock repurchased. As I told you, it's technically it is illegal. You cannot buy back your own stock blindly. So you have to take permission from the stock exchange. So sometime, but here we are discussing benefits of stock repurchased. If you are buying back your stocks, so your earning per shares will increase. You remember EPS formula? It was net income minus preferred dividend divided by number of weighted average number of common shares outstanding. So number of shares is the denominator. Obviously, if you are buying back your stock, so number of shares will reduce because you have to take outstanding shares here, right? Weighted average. So if you are buying back your stocks, so outstanding shares will be reduced. So automatically EPS will increase. This is the another benefit. Then to prevent a hostile takeover, sometime if someone is trying to acquire your business through the acquisition of shares, so to protect your company, you can buy back your stock, right? So just to stop the hostile takeover. So this is what is the, it could be a preventive tool also, okay, to save yourself from the takeover. Then to eliminate a particular ownership interest, maybe you don't want certain peoples to be the owner, so that's why you are buying back your shares. So there could be any reason. So guys, this is what is the total theoretical things for today.